Alright, let's dive straight into Huahai Pharmaceutical. This isn't just another company report. It's a story of transformation and ambition. We're looking at a firm that's not only solidifying its position as a major player in the active pharmaceutical ingredients API market, particularly in cardiovascular drugs like sartans and prils, but also strategically pushing into new therapeutic areas like CNS, anti-infectives, and more. Their game plan is clever. Leverage their strong API manufacturing base to build a global presence in finished formulations, while simultaneously investing heavily in the future through biopharmaceutical innovation. So, what's the bottom line? First off, their core API business is rock solid, especially in those big cardiovascular segments. But they're not resting on their laurels. They've successfully launched new products across different disease areas, creating a much richer product portfolio. The formulation strategy is key here. They're not just selling APIs, they're building a global brand with formulations, optimizing everything from production to sales channels. And then there's the exciting part. Their biopharma arm, Huahai Bio, is making serious moves in cutting-edge areas like bispecifics and ADCs. Financially, we are projecting steady growth and, importantly, improving profitability as these strategies take hold. Now, let's look at the numbers. As you can see, 2023 was a bit of a mixed bag for revenue, barely growing, but net profit took a hit, down significantly. Why? Well, factors like the impact of centralized procurement in China and ongoing price pressures in the API market played a role. However, the forecast looks much brighter. We expect revenue to pick up nicely in 2024, growing over 14%, driven by both formulation sales and new API products coming online. Net profit is projected to rebound strongly, up over 34% in 2024, and continue its upward trajectory through 2027. Notice how the PE ratio drops from a high 38 times in 2023 to under 19 times by 2027. That reflects our confidence in the earnings growth potential. The PB ratio also comes down, suggesting the valuation becomes more attractive relative to book value as the company grows. Based on this analysis, we're initiating coverage with an overweight rating. Why? Because we believe the combination of their strong API foundation, successful global expansion into formulations, and the promising progress in their biopharma pipeline creates significant upside. What could really make the stock jump? Several things. If their formulation sales, especially internationally, exceed expectations, that's a big one. A rebound in the prices of key APIs like sartans and prils would directly boost margins. Breakthroughs in their R&D pipeline, maybe even licensing deals for their innovative drugs, would be huge catalysts. Getting new approvals, both for APIs and formulations, domestically and abroad, keeps the momentum going. And finally, continued success in navigating China's complex tendering system is crucial for domestic growth. Let's zoom out and look at the company itself. Huahai isn't some newcomer. They've been around since 1989 and listed publicly since 2003. They started as a chemical intermediate producer but transformed into a major pharmaceutical player specializing in APIs. Think of them as one of the top specialists in China for making the raw materials for certain types of drugs. Globally, they are a heavyweight supplier, particularly for sartan and pril APIs used in blood pressure medications. But they're not just sticking to one area. They're actively diversifying into other important therapeutic categories like central nervous system drugs, anti-infectives, digestive aids, and respiratory treatments. Crucially, they're leveraging their API expertise to move downstream into making finished drug products or formulations, and they've been doing this globally for a long time, especially establishing a strong foothold in the US market. How is this business structured? Look at Figure 4. The revenue trend shows some volatility, but the overall direction is upward. Now, look at Figure 10, the revenue mix. See how the share contributed by formulations has grown steadily from less than half in 2020 to over 60% in 2024. That's a major strategic shift. Figure 6 shows the profitability trends. Gross margin is generally healthy, supported by the high margins on their domestic formulations and the fact that overseas formulation margins are starting to improve. On the expense side, as you'd expect for a company expanding globally and investing in new products, sales expenses are up, reflecting investments in building that global network. R&D spending remains a significant part of the budget, fueling their innovation efforts. Overall, the performance is driven by the resilience of their core API business, the strong growth in formulations, and the potential unlock from biopharma. Let's dig deeper into the API business, the bedrock of Huahai. They're not just a player, they're often the leader, especially in cardiovascular and CNS APIs. Think about sartans and prils. These are workhorse drugs for hypertension, and Huahai supplies a huge chunk of the global market. Figure 15 shows their revenue breakdown by therapeutic area within APIs. While cardiovascular remains a major contributor, CNS APIs have shown rapid growth. Even with price pressures, their gross margins here remain quite robust, around 50%. Figure 20 illustrates the price trends for some key sartan APIs. You see the volatility, especially after the 2018 impurity scare, but notice how prices have found a floor recently. With some excess capacity being phased out, there's a real possibility of prices recovering, which would be a nice tailwind for this segment. Huahai isn't content just dominating the old guard, they're actively building new empires. Look at figure 22 and 23, the number of new API approvals and regulatory filings they're getting each year is consistently increasing. This shows they're successfully expanding their product range beyond just cardiovascular and CNS into areas like anti-infectives, GI, respiratory, and oncology. They're not just developing new products, they're selling them globally. In 2024 alone, they added over 150 new customers worldwide. And they're tapping into new markets too, like India and the Middle East. To support this growth, they're investing heavily in modernizing their production capabilities, moving into more complex areas like high-activity compounds, peptides, and fermentation-based APIs, as detailed in Table 2. This capacity upgrade is crucial for handling the demands of these newer, often more challenging products. Now, let's talk about their formulation strategy. This is where they're really trying to leverage their API strength. Think of it as a two-pronged attack. The API business provides them with a cost advantage and ensures a stable supply chain for their own formulations. The formulation business, however, offers higher profit margins and direct access to the end patient market. Domestically, they're smartly navigating China's centralized procurement system, using it to gain market share for their products while simultaneously strengthening their sales channels beyond just hospitals, reaching pharmacies and even online platforms. Internationally, they've been pioneers in taking Chinese-made drugs to the US market, building a sophisticated multi-channel network there. They're constantly adding new products to their portfolio, both through their own R&D and by bringing in promising candidates from elsewhere. The key takeaway here is the potential for overseas formulation margins to really lift the overall profitability. This is where the crystal ball comes out, the biopharmaceutical side, run through their subsidiary Huahai Bio. This is their bet on the future, focusing on truly innovative therapies. They're targeting some of the biggest challenges in medicine: autoimmune diseases, cancer, and eye conditions. They're not just dabbling, they have the technical chops to develop various advanced formats, including monoclonal antibodies, bispecific antibodies, which can target two different targets simultaneously, and antibody-drug conjugates, which are like guided missiles delivering drugs directly to cancer cells. Their pipeline looks promising. Candidates like HB0017 and HB0034 are already in late-stage clinical trials, meaning they're close to potentially hitting the market. Others, like HB0025, are showing early signs of potential. The goal here is ambitious: to create biopharmaceuticals that can compete globally, not just domestically. Of course, no investment thesis is complete without acknowledging the risks. The pharmaceutical world is tough. Competition is fierce, both in the commodity-like API space and in the more differentiated formulation and biopharma markets. There's always the risk that sales might not meet expectations, whether due to market dynamics, competitor actions, or pricing pressures. We've already touched on the ongoing pressure on API prices, which can squeeze margins. And finally, R&D is inherently risky. Developing new drugs is expensive, takes a long time, and there's no guarantee of success. Clinical trials can fail, regulatory hurdles can be insurmountable, and even if a drug works, it might not be commercially viable. These are the headwinds that need to be managed carefully. To wrap it up, Huahai presents a compelling picture. They have a solid, reliable API business providing the financial backbone. They are effectively growing their formulation business, both at home and abroad, leveraging their unique advantages. And they are making significant strides in biopharmaceutical innovation, positioning themselves for future growth. The synergy between their API manufacturing and formulation development is a key strategic advantage. Looking ahead, the path seems positive, driven by their diversified approach and the execution of their multi-pronged strategy.